Hello and welcome to Tideline's Compass series on impact investing. Thank you for joining us today. I'm Jane Bieneman, Senior Advisor at Tideline. Today, we'll be talking about investing with a focus on DEI, or diversity, equity, and inclusion. At Tideline, we've been seeing absolutely huge growth and interest in this topic among our clients and in the market overall. This interest has been coming from all corners, from all types of players. We've seen corporates, for example, start to step up in a big way on DEI. PayPal, to pick one, has committed over $500 million to investments to advance racial equity. Banks have been using their influence in new ways, including through policy change. Goldman Sachs, for example, has said, we won't take a company public that doesn't have a diverse board of directors. And we've seen the asset management industry step up, including asset owners becoming more and more vocal about DEI, such as through ILPA's new initiative that we're excited to talk about today. So it's a promising time for DEI in our industry. However, I do find myself somewhat holding my breath because while there's this flurry of activity, it's not entirely new. I come from Wall Street, where we've had diversity efforts for literally decades and the needle hasn't moved. And that's really true across the financial services industry. We all know the somewhat dreary statistics. 2% of VC capital goes to women-owned companies. Less than 1.5% of total investment industry AUM is managed by women and people of color-owned companies. Wall Street continues to be overwhelmingly dominated by men at the senior ranks, and so on. So what is different this time? What have we learned about what works and what doesn't work? I'm very excited to talk to our panelists today about how this time is different and what their programs look like in terms of strategies, in terms of data and measurement, in terms of accountability. How can we maintain lasting focus on DEI and do it in a smart and scalable way this time? So I have a lot of questions for our panelists. In addition to my questions, we hope you will submit yours. Please do so through the Q&A feature on Zoom, and we'll reserve time to respond to them towards the end of our session. So I'm truly delighted now to introduce our panelists. Jen Choi is Managing Director of Industry Affairs for the Institutional Limited Partners Association, or ILPA. Jen directs ILPA's work with external stakeholders to strengthen the organization's education, research, membership, and advocacy platforms. And Jen also leads implementation of ILPA's responses to emerging issues. Charisse Cederqvist joined Prudential in 2013 to head the company's emerging manager investment program. And Katie Moore is Managing Director at Hamilton Lane. She is also our best sports person of the panel, recovering nicely from eye surgery, but protecting her eye with the glasses. So thank you, Katie, for joining us. Katie is Managing Director at Hamilton Lane and leads the firm's emerging and diverse investment programs. She's also a member of Hamilton Lane's Responsible Investment Committee and co-chairs Hamilton Lane's Diversity, Equity, and Inclusion Council. Roy Swan. Roy leads the Ford Foundation's Mission Investments program, which deploys endowment capital into market rate impact investments, makes program-related investments for catalytic opportunities, and also makes grants in support of the broader ESG and impact investing markets. So thank you all for joining us today, and let's get into our discussion. Jen, if I may, I'd like to start with you. A few moments ago, I referenced ILPA's new initiative, which is called Diversity in Action. Would you tell us about it, what it is, who it's for, and what the goals are?
Absolutely, and thank you, Jane. Thank you to the Tideline team for including me in this conversation. Jane, I love this setup. What's changed? Is this time really different? And if it is, why? So the initiative actually was launched in December of 2020. So we've just passed the 1-year mark. And really the intention when we started was to try to do more to define what good looks like through the eyes of LPs, but also understanding what are GPs, what are allocators doing. And so we've created a framework, and I believe we can put the link in the chat to the framework so that everybody dialed in can see that. But we try to create a framework anchored around intentionality, accountability, transparency, and engagement that both LPs and GPs could see themselves within. We also tried to make sure that it was sufficiently aspirational, but not exclusive. So not a series of actions, activities, practices that are solely the domain of the largest entities, the largest LPs, the largest GPs, the largest allocators, but really something for everyone. And we've been really gratified now. A little over a year in, we have 224 LPs, GPs, funds of funds, consultants who joined us in this effort. One of the things that I would call out for the audience is that it is not a pledge. We take a lot of pride and care in that. So we're trying to find those organizations who are not just committed to advancing DE&I, but taking specific actions in the name of the initiative for a reason. And we validate. We do ask the individuals and the organizations applying to become signatories to join us in this work to give us the details to really expand on what are they doing to live the elements of the framework that they have in place. How are they pushing themselves? What do they want to learn? This is a community of practice. It's meant to be a forum for candid exchange of ideas, for a bit of vulnerability and sharing of challenges, as Katie knows, having been at some of these roundtables that we host each quarter. But we really want to bring people together to put things out, to be generous with where they're struggling, where they want to learn. And we have been blown away by how much information is flowing within this community, within this network, and how much they've really leaned in and engaged in helping to not just advance the specific practices that they can undertake and understand tactically what have other organizations done to address shared challenges, but also be part of the solution. And two big things that came out of the Diversity in Action Network last year, alongside the ILPA team, were revisions to the diversity metrics template and an expanded set of DE&I questions within the ILPA DDQ. And all of this in service of asking better questions, deepening the line of inquiry so that LPs and GPs are having a differentiated conversation and really moving the ball down the field, to use an overused metaphor. But we're really pleased with the progress. We've heard from a lot of signatories already that they are putting the DDQ and the metrics template into practice. And so we're eager to continue that dialogue, and certainly happy to take questions from those listening in about the initiative and can expand a little bit further as we go through the conversation, Jane.
Great, thank you, Jen. And I will say we use this initiative often already in our work at Tideline, and really appreciate your leadership on it. Roy, if I could turn to you, Ford has been a leader in using the full spectrum of capital to advance positive social outcomes, from fully concessionary grants at the one end to market rate mission-related investments at the other. I wanted to ask you specifically about the $1 billion market rate portfolio that you oversee, and how you think about DEI in the context of that, what DEI means, and also if there are some sources or standards that help to support or inform your approach that might be interesting to share with our audience today.
Great, thanks, Jane. It's really great to be here with everyone. Can you hear me okay? Is it coming through okay? Yeah, great. So first I want to, Jane reminded me when you mentioned that we've been kind of at this diversity thing for decades, one could say for over a century, but it reminded me back in, I think it was 86 or 87, my first job out of college was with an investment bank called the First Boston Corporation. For those of you who are under 50, you may need to pull out your Google. But I was in the M&A group there. At the time, was run by two men, Bruce Wasserstein and Joe Perella. And I can remember we had a project, Paul Robeson, which was intended to increase diversity. Well, the crash of 87 came. Project Paul Robeson went by the wayside. Which happens quite a bit. I'll throw out one other thing for folks to go look at on your own time. The Kerner Commission, which was probably the last time we had such a wake-up call that I think a lot of people refer to the George Floyd situation and pandemic coming together. I've heard it described by many as a wake-up call that opened many people's eyes to some of the inequalities that have existed in America since its founding. But every now and then, incidents can happen that draw things to our attention, and it's really great. And I do believe it is different this time. I also want to draw attention really quickly to one of the dismal statistics you raised, because I want to compare it with what we are doing. I think you mentioned was slightly over 1% of the over 70 trillion in assets under management allocated to diverse owned fund managers as women and people of color. And for the mission investment portfolio, that statistic is not 1%, it is 63%. And in terms, that's capital. In terms of number of funds, it is 82%. And so that is just an indication of what can be accomplished when you want to accomplish it. The 63% is high in comparison to that 1%, but it's lower than the incidence of women and people of color in the American economy. So some might say that we're still failing, even though we're outperforming the market in diversity. Generally speaking, the $1 billion, just to dial back for a second, the $1 billion commitment is for us to find big social problems where we believe we can generate risk-adjusted market rates of return. In the US, there are 3 investment themes: multifamily affordable rental housing, quality jobs, and then diverse fund managers, which is a category that goes across sectors. Outside of the US, it is financial inclusion and biotech and healthcare. In the US, our diversity is focused on women and people of color. Outside of the US, it's based on women. That's the way we categorize our diversity. I'm going to stop there to give time for others.
Well, thank you, Roy. It's really great to hear that perspective and exciting to hear about the composition of your portfolio from a diversity standpoint. Charisse, if I could turn to you. Prudential announced a very large commitment last year to its DEI portfolio program that you lead. Would you tell us about the program strategy, including how you define DEI and think about the program's goals?
Sure, and thank you so much for having me today. I think the first thing I would just address is keeping with the theme of why are things different this time. I think companies are used to external pressures from their clients and their customers who may demand change or may want to see progress. But I think this time, certainly what we're seeing is that it's not just external, there's a lot of internal interest as well. So if you really want to be a top performing organization and retain the best talent, you really need to address the fact that so many people right now want to work for a purpose-driven organization. And that may have been something in the past that would be separate and apart from financial services, but I think people expect both. So we've certainly seen interest from our clients as well as our employees who really want to know that we are doing something sustainable that's really going to make an impact on an ecosystem, if you will. And that's really what led us to this DEI portfolio. We've committed about $200 million in capital, and it will be devoted to private equity investments. We'll be taking LP stakes, but the focus is really viewing a universe with a DEI lens. So we'll be looking at first and second time funds that are managed and or owned by women and minorities. And I think that's an important distinction because in the past, I think the industry as a whole has tended to be a little specific in defining DEI. And a lot of state pension plans define it just by ownership, 50% or more. And so what we've recognized is that if you want a bigger universe of investment possibilities, then you've got to really expand that definition. So we view it as substantial ownership, 25% or more roughly, and then decision-making. So if there's a woman or a minority at the helm that is really critical to that investment process, then we would certainly consider that.
Great. And how do you think about building that funnel of opportunities that you just described as you try to work to expand that opportunity set and perhaps identify opportunities that a traditional investment manager might not find? How do you build that funnel and think about your pipeline and opportunities?
Sure. Well, the exciting thing is that there's no shortage of pipeline. I mean, it's been very exciting to see the number of first-time or second-time women and minority funds that have come to the forefront to be considered. So that's been very positive. But when you think about sort of traditional asset classes, maybe long-only equity, and you think about how to expand it there, that's something that we are looking at right now. So we've just engaged with an organization called Lenox Park, and you may have heard of them. They have something that you might refer to as a FICO score for diversity and inclusion. And we are going to be engaging with them to apply their sort of standardized metrics in looking at asset management firms and engaging their level of diversity. So again, it's just another tool that we hope will help us broaden the framework for finding potential firms to invest with, rewarding, behavior that we'd like to see, and really just trying to build an industry and reward different levels of diversity and inclusion.
That's terrific. We do have a question from the audience that I'll ask you now, which is, is your program available to external investors? Is that something you might do down the road, or what are the opportunities for external folks?
Yes, I mean, we're looking at external managers. We have we've quite a few in the queue right now, but yes, we've been speaking to a lot of funds that are launching, and it seems like a lot of the time frames are very tight. But we've certainly taken a meeting with everybody that's come forward to
Great.
express an interest.
Thank you, Sharice, and I know you do need to drop off at the half hour, so I'll thank you now for your insights and time. Katie, yeah, absolutely. Katie, turning to you. Hamilton Lane is, of course, one of the largest institutional investment advisors and plays a really important role in how capital is allocated in the market. Would you tell us about Hamilton Lane's DEI strategy, including the emerging and diverse investment programs? What are the goals and kind of overarching criteria? And lastly, Hamilton Lane has signed, of course, ILPA's Diversity in Action Initiative, so it'd be great to hear how that informs your approach as well.
Absolutely. Thank you so much for having me. I do want to thank Jane and her team for being so inclusive to someone who has a short-term disability and allowing me to participate today. Maybe I'm starting a new Zoom trend with my shades. But it's interesting what you say. We are a large asset manager today, but we didn't really start that way. So, to Roy's point, 30 years ago, we were actually founded as a firm that was solely focused on helping clients find emerging managers, if you can believe it. So we have stories, if you think about back that time frame, TPG was raising their first fund and Blackstone was on their second fund. So it was really like the dawn of the private equity age, if you will. And those groups had to come through our door, which is great because, it sort of has helped us build these relationships over time. But what it really did was give us this foundational and really a firm perspective that emerging managers should be a part of a core private market program. And I think we've taken that philosophy and rolled that forward over the last 30 years. I know I'm speaking specifically about emerging managers, but I do think that emerging and diverse today are still very much intertwined. About a third of the funds that come through our door that are emerging managers do sort of qualify as diverse, right? And so I think that's a great number, but I'm hopeful that in the future, we're not actually having to track it, and that every firm that comes through the door, regardless of emerging or established, sort of can hit that threshold that we expect. So I think I just wanted to clarify here that yes, today our programs are very much intertwined, but the goal in the future is that they don't have to be, that diversity will be common across this asset class. So from our perspective, obviously today, clients and what their portfolio requirements have evolved. But I think what's really been great is you're seeing clients who want to align their investments with their values today. And so not every client sort of separates their new and their diverse relationships. A lot of folks, similar to the Ford Foundation, it is embedded into everything that they do. And so for us, we want to find those new relationships. We want to make introductions, but we want to also layer in portfolio construction. And I think that's a key piece. We put about $11 billion to work in emerging and diverse managers in the last 2 years. $11 billion. Now that's across the whole client base. So I know we represent a lot. It's a lot of institutional capital. But if you think about it, the average LP is doing, 10 funds within their core program. And so while you do have dedicated programs that allow for, smaller bite sizes to more managers, we're really helping clients think about making sure this is embedded and is part of everything that they do. So I think that's the key tenet, that's the key goal of our program. Last year alone, we saw about 1,200 funds come through our door, and roughly 40% of those were emerging managers. And like I said, about 30% of those are diverse, and so on and so forth. So there's a lot of great momentum. There's a lot of folks to meet. And we're really encouraged to sort of, continue to find those managers, to put capital to work with them, and to layer in the portfolio construction alongside of it. The last thing I'll say on the ILPA diversity in action, I mean, Jen knows this, we've been working really, full steam ahead for the last year. It's fantastic. I think that we do this GP outreach every year. We do a survey with our big GP relationships. And a year ago, we asked them, what percentage of your LPs ask you for your diversity metrics? And do you know that less than 10% said that LPs ask for it? And only at the time of diligence. So fast forward a year, you've now got this incredible universal template. And so we've seen, the numbers haven't ticked up to the point that we'd like them to, but it is a much bigger percentage. And I think that ILPA has absolutely been instrumental in doing that. So I'm super excited about the initiative. I think we've got a lot more runway to go. And I'm really excited to see the GPs, the LPs, the asset allocators, we're all working together. And that's just been a huge sort of momentum shift and change. So change will be too slow for some, but I do believe ILPA is really pushing us forward. So.
Thank you. It's great to hear about the collaboration and the momentum that's driving. So that's fantastic. Great. Well, I'd like to go forward with some more questions for the group, turning a little bit to kind of implementation. Kind of like to get into how you diligence, how you make decisions around DEI-focused investments. So thinking a little bit about the nuts and the bolts of your process. And Roy, if I could start with you. When you I'd like to ask you what you look for when you are assessing opportunities where you're looking for a strong DEI outcome as well as your target financial returns. What are the characteristics that you look for in the criteria that are really important in your experience?
Well, that would be called a layup question, because and it's good news. It's really easy because it's no different than looking at any other manager. The difference is that the door is open to managers that heretofore the door has been closed to. So from my perspective, it's couldn't be easier. I do want to rain on my own parade for a moment and say that, just to be fair, the reason why, part of the reason why we have such a high allocation to diverse fund managers is because we're starting fresh. And so I just want to be fair to those who have existing mature portfolios and only have the dry powder that's produced through distributions to reallocate in a way that might reflect a wider aperture. By wider aperture, I mean including diverse fund managers. I also want to say, just to double down, Charisse has left, but I really appreciate everything she said. That wider aperture could include less stringent requirements on the definition of diversity. Things are so horrible that anything is better than nothing. And so that 25% level, the significant or meaningful input or position, I think is really important. You know, some of the earlier programs, going back again to the 70s, 80s, sometimes when you had the high ownership requirements, it incentivized some nefarious behavior where basically scams were became all too frequent. So I'm also, you know, really appreciate what Hamilton Lane has been doing. In addition to the fact that Hamilton Lane was formed to focus on emerging managers, one really neat fact is that Hamilton Lane was founded by a Black man. And so the firm has really become, it's really grown over time, starting with the focus on niche, at the time, very niche, diverse fund managers. But in addition to Hamilton Lane, we wanted to have exposure to diverse fund managers as quickly and as prudently as we could. So we actually did tap a number of fund-of-funds. For technical reasons, we could not work with Hamilton Lane because it turns out that one of our trustees is, one of the Ford Foundation's trustees is married to the CEO of Hamilton Lane. So that ruled out Hamilton Lane. But there are firms like Fairview Capital Partners, which was founded in 1994. Like Hamilton Lane, it started out focused on diverse fund managers and has broadened. There's Plexo, there's Grosvenor. There are a number of firms that have been around. They have collective decades of databases. They know every diverse firm out there. So it's really, really easy to do it. It's just like traditional investing. The difference is you will have a wider aperture to consider diverse fund managers. I'll stop there.
Great, thank you, Roy. Katie, I'd like to ask you, similarly, how does Hamilton Lane diligence a DEI effort the same? For example, is it the same set of criteria that you would use otherwise, and if not, how is it different? And I'd also love to hear how you think about data in your analysis, sort of what you're expecting to see from GPs, qualitative data, quantitative data, what you look for. You talked about going from the couple percent to higher in terms of data, but kind of how you think about diligence, and then particularly how you consider data availability in your
We love
assessment.
data. We're a big data firm. I always say I don't really work for a private equity firm. I work for a marketing firm / data firm. Like, we're good at those two things, and it makes the private equity stuff look really good. So to what Roy said, there are so many great firms that are searching for groups and do have capital, right? And there's enough for us to all go around. So you can have plenty of firms out there doing this, and there's plenty of room for all of them. And I think that's the exciting thing, is the opportunity set has just grown. And so we spend a lot of time looking for every manager out there. Our goal is to meet the market. And I think that this year, 2021 more than ever, 1,200 fund opportunities. I'm sure that folks hear that number and they think like, wow, but that is the highest we've ever had. And so you think about this fundraising environment, the fact that 40% of those are considered emerging funds, there's a lot of groups to meet. And so Roy and his team are very busy. We're very busy. We got a lot of work to do. I think one of the challenges that we have, to Roy's point, we're not starting from scratch in most of our programs. And so you do have this balance of existing relationships with adding in new relationships. And I think the importance of portfolio construction and using data have never been more important, because we do want to make sure that we're being tactical and that we're adding. One of the challenges we're having with this year with all of those managers back to market, think about it, 15 of the largest firms in the world are raising 20 billion or more. They've all been most of our clients' portfolios for 30 years. So we've got a challenge of choice here, right? I mean, are you looking at the manager who is arguably trying to make strides within diversity, or do you pick the fund that is, it got it built in and it's key to their DNA? I think there's a real conversations we're having with clients, and there's no sort of one silver bullet that works for each of us. We've got to really pull it apart from every level within diligence. The good news is there's no like right one answer or silver bullet. So our approach is to really meet the managers where they are. It's to gather the data now, not just at time of diligence, but annually. It's to talk about what they're doing internally, recruiting, inclusion. If a GP has 10 folks and they hire one person a year, chances are they're not going to move their needle significantly in 1 year, but what approach should they take to hire that one person? And what are the organizations they're partnering with? And, just the things that make us understand how their values align with ours. And so that's really how we think about them, and we're trying to meet them where they are today. Now, that being said, we are having a lot of conversations with managers who are not diverse to say, you can't come back here in 4 years for more capital, for 2 years if we're in this market, and look like you do today. Like you have to take this more seriously. And so I think, again, change will be too slow for some, too fast for others. We're trying to meet them where they are. The key is to ask for the data. And I think that's where Jen and her team is coming in and pushing this industry forward. I mean, you have got to ask, and not enough LPs are asking. And so I think it's on the asset managers right now. It's on groups, like the Ford Foundation, but it needs to be more universal. This can't be, something that the GPs are not being pressured to do. So I think that's how we use some of the quantitative data to track its score, plus the qualitative, plus the portfolio construction. It all sort of comes together.
Thank you, Katie. That all resonates with me, including the comment that there's sort of no one right approach. And so much of what I think we're all doing in the industry and we're doing in Tideline is trying to get the right transparency into what those different approaches are. And that's part of that is definitely the data side, which is a nice segue to a question I wanted to ask you, Jen, and really around kind of accountability. This is an area that your working group, the Diversity in Action group, has identified as needing improvement. So I guess my question is, what specifically, based on the feedback from the working group, should LPs and GPs be doing to increase accountability and rigor when it comes to DEI-focused investing?
I think there are sort of three ways to start to answer the question. And the first I'd point to is the importance of looking inward. And we made the comment earlier, and we were all vigorously nodding our heads. It's not just about external client pressure. There's really this internal desire to be better, to do better, and to be accountable in how we set our goals and meeting those goals. And so one of the things that we've started to see emerge with the signatories to Diversity in Action is thinking about performance appraisals, and usually cascading down from senior management. But how do you tie that end of year assessment process to the individual's contributions to culture, to values, to any specific DE&I objectives that are relevant for their particular mandate within the organization? I will say we're very early days with that. And I think it's one opportunity for LPs and GPs and allocators together to be thinking about, well, what is a reasonable way to do this, to sequence this? How should we be thinking about it in practical terms? But that's one. Another is benchmarking. I'm really trying to define, well, again, what does good look like? Understanding that we're all on a journey. I talk to GPs all the time who ask, well, how do I stack up to my peers? And groups like Lenox Park, I think, are trying to build some of that information. And certainly NASDAQ is trying to do that with their investment platform and making those metrics available to the asset owner community. But I think we're all fumbling a little bit, not knowing where are we today so that we can start to set some of these goals and objectives, not as the ceiling, but as the floor against which we measure our progress over time, and then start having that conversation as part of not just the diligence process, and this is kind of the third pillar I'd call out, but on an ongoing basis. So it's not enough to ask the question when you are starting a new relationship, as you're an LP engaging with the GP for the first time. You have to follow up. You have to bake into the conversation from the first time you ask about it. I'm going to ask you again on your next fund, and it's going to be a factor in the consideration set as to whether or not we re-up in that successor fund. It is a topic and a section, not just a throwaway bullet within the ESG analysis that we present to our investment committees. It's a topic of conversation, really forcing that conversation to come to the fore on its own discreetly, as opposed to being subsumed within a broader ESG assessment. And I will say that the LP conversations that I'm having, this is happening. And there are some LPs who are very loath, even with an existing relationship with the GP they like, they are loath to bring that fund forward for the re-up in their investment committees, with their trustees, with their boards, because they know it's either going to be shot down or it's going to raise all kinds of very, very difficult questions. And I've also heard LPs say that it's not so much the metrics. We understand everybody is on a journey and we all have to start somewhere, and it's going to take a long time in some shops because there's not a ton of turnover, there's not a ton of growth, the teams aren't expanding dramatically year over year. So what else can you say? What else are you doing, for example, to engage with your portfolio companies? How are you thinking as a GP about how you're deploying capital? Are you actively seeking out diverse suppliers? Are you actively seeking out diverse entrepreneurs? So it's not just about the metrics, it's about all the other things around how you are taking specific action to make the diversity of your own organization and the diversity of your portfolio look different over time. That sounded a little preachy, sorry about that, but I think there are lots of ways to think about accountability. I guess last capstone comment for me would be, until allocators are voting with their capital, it's really hard to see how we will collectively as an industry and an ecosystem be able to look ourselves in the mirror and say, yeah, we are holding ourselves accountable to make this time different.
Great, thank you, Jen. That's really helpful. I'd like to take some questions now. We have a bunch of questions coming in from our audience. Thank you. And there are a couple of questions that are around elevating smaller managers, smaller diverse managers, that many of the diverse managers in these networks are smaller. How can we move them into the space? What's the mechanism to get participation in these smaller innovative funds, secondaries, or others approaches? I wonder if the panel could address the mechanisms or thoughts about elevating some smaller managers. Katie, maybe put that to you.
Sure, absolutely. I mean, someone asked about our I'll start with their definition of diversity and emerging, I guess, if it's just easier. So for us, emerging manager is really any fund 1 to fund 4, but really fund 3. A lot of time there's like pledge funds or capital coming over. So fund 1 to 3, sort of sub 2 billion. And I know every client, every LP has their own definition. That's just ours. Within diversity, we look at 4 different metrics. We look at greater than 25% by ownership, by carry diversity, by investment committee, and by investment team. And so for us, an organization has to hit 2 of those 4 boxes above 25% to sort of qualify as a diverse-led organization. Again, it's really for us to just be able to put our own track record and stamp together. Realistically speaking, obviously, we're looking to move the needle beyond that. I think that for most of our client accounts that are looking for, emerging managers, diverse managers, all of those within some parameters work. There's really no lowest fund size, if that makes sense. I mean, we are out there trying to meet the market. And so while there are some groups that can only raise 5 million, and I'd argue most of those are actually women, and you should raise way more than $5 million, by the way, raise more than you think. But I would just say that having the early relationships, getting in the door, I think that Roy and I are very easy to find. I mean, there is a process, there is a submittal process, but we want to meet the groups. And so even if it's a no today, get on our radar. Let's start the conversation, because I can make introductions to the endowment that is doing smaller ticket sizes. And so maybe when that endowment comes in 3 funds, I can introduce you to the pension fund that wants to get to know you and put in 50 million or 100 million. So these are just some of the things that we think about, and there's no minimum ticket size, in my opinion. Brad, I don't agree with that.
Agree with everything Katie said. Yeah, it's the networking process is very intense, meaning that smaller funds, just, a lot of shoe leather. But ultimately, people generally want to help. And so the networking effect of reaching out to folks like Katie, Jennifer, and whoever, we start spidering out. And so that's, I can't give any better advice than what Katie gave.
Great. Thank you both. There are a number of questions about how we make more progress, kind of why we have the pace of progress that we do. I wanted to ask Roy, you start with a question around that for you. Ford's numbers are very impressive, the DEI numbers that you cited in the portfolio. And I'm wondering to what extent you think it's helpful that you are in the leadership chair, and what your thoughts are on having diversity in the allocator seat, as well as we've been talking about the manager side as well, but what does that do for dynamics?
Yeah, well, this is not my opinion. This is statistical information from psychology, sociology, even economics. I am less likely to be biased, certainly with respect to people of color, than a white male. That's just statistics. It's not my opinion. That's conscious bias, unconscious bias is less likely. So I think there is something to what you said, at least in today's world. That may change over time, but that is the reality. And so I think that's why you're finding such interest in increasing the diversity of not just fund managers, but businesses, because the other thing that is statistically true is that diversity when it comes to people of color in corporations leads to higher productivity and a higher likelihood of financial outperformance. That may have to do with the innovation that comes along with different points of view. So I'll stop there.
Thank you. I think it's such an important. I think it's such an important point, and gets to some other questions we have, which is really around leadership and how we're thinking about accountability and pushing managers, I think, and allocators from a leadership perspective. Jen, maybe you could talk a little about that, about how we're encouraging results from a leadership perspective among organizations. And there's also a second question for you on whether you're going to be rolling out a similar framework for VCs in particular.
Well, I think the refrain around pipeline, right, and how do we recruit people who have diverse life experiences, who come from underrepresented groups into positions of leadership, to be the ones in the room who are making decisions around how the capital gets deployed. I think everyone's having that conversation. And at the same time, there is a real struggle to break the mold on the profile for talent in private equity and in venture capital as well. And venture's been really leaning into this challenge over the last several years, but I think a lot of it still comes back to we're all fishing in the same ponds. And those ponds aren't terribly deep. And if your expectation is, to be good at sourcing and doing deals, you have to have attended certain institutions. And you have to have spent a minimum number of years on Wall Street in certain institutions. That is going to hobble your efforts to find the diverse leaders of the future coming into the industry. And there's a tension, right, between what LPs expect to see when they're looking at the profile of the individuals leading the firm and this desire to really see greater representation, greater diversity of experience of thought among decision makers. And I don't think that we've resolved that tension at all. But I know a lot of very committed people are trying to figure out how to do just that.
Great. And we have a couple of questions around implementing these strategies in particular emerging markets. One question is around data and measurement in emerging markets, that can be difficult, I think if not illegal. So the question is getting the take of the panelists on how to increase diversity when you don't have access to data. So is that a correct presumption that you don't have access to data? And if so, what do you do about it? Roy, I see you nodding. Maybe we start with you.
Yeah, just really briefly, I mentioned early on that outside of the US, we focus on gender, not race.
Yeah.
And that does reflect the fact that the legality around race data is different outside the US. And so that's one. And two, there's it's complicated for us, at least, to understand, given all the various jurisdictions, sort of how race impacts what biases there are against different races outside the US. So we just don't even make that complicated. There's enough opportunity just focused on gender inequality. So we collect that data and we're satisfied with it.
Great.
We ask to, look, we ask for it. Not every firm can give it to you, and that's okay. So we ask for racially represented and racially underrepresented outside the US. And to the extent that it's provided, that's great. To the extent that folks can self-identify, we'll take any and all information. If not, that's okay too. I think for us, what, again, it comes back to is more than just sort of those figures. It's inclusion. It's moving the needle in terms of their programs and their efforts and how they're really thinking about it as part of their strategic objectives as a GP. Is this embedded to what you're doing? And I think you can really have those more qualitative discussions, and that's where it really comes into play, in the non-US world. But I think where it will be a challenge, and Roy would love to get your perspective too on this. It's easier to ask the GPs. It's harder to get it at the company level. And I think that we as an industry have an opportunity to figure out that transparency and that change. And I think both the Ford Foundation, Hamilton Lane, and a few others are partnering and investing in a company that's called Novata, Novata. But there's other companies out there that are certainly focused on ESG reporting from a company perspective. Mm-hmm. Because if you think about real change, there's over 10,000 private equity firms, but there's 100,000 portfolio companies. And so if we can get that data and that transparency somehow, it will be harder to collect internationally, but just even asking the question is moving the needle. And I think that's where our industry needs to go, because that is where folks really care. These are the underlying companies. This is the commerce. This is where the actual dollars are going. And so when you ask, even if whatever you get back is good today, how we then take that information, make decisions off of it, it will have more of a qualitative angle to it.
Yeah, I'll just say, just to emphasize Katie's, there is I would say wind is at the back of an ecosystem of entities that will help make transparency an easier objective. So there is Novata, obviously the Value Reporting Foundation with the SASB standards. There is the corporate call to action that Ford Foundation was engaged with some of the largest institutional investment managers that are calling upon their portfolio companies to provide the data. And there's even, Tideline Blue Mark that will help make it easier for us to verify. So we're feeling very good about the emerging ecosystem of entities that will help highlight and facilitate transparency.
Great. So I think we have time for one more audience question. Sir, we've talked about kind of widening the aperture. We've talked about how smaller funds can get on the path to raising capital. So turning back to that a little bit, there's a question about track records for emerging managers. And when I'm curious, Katie, I think Katie and Roy, how you diligence the track record, how you establish a proven track record when you're looking at first-time fund managers, and whether that is surmountable for your portfolios.
I don't know, Roy. It's probably where we spend the most time, right? I mean, that's I'd say for us, the first thing, help us make the link is always the best. So, just helping us piece the story together. So whether you were an operator for 20 years and now you're looking to raise a fund, like help us link it to what you did, what your experience, how you're building the team. All of that is helpful and will be evaluated. We also spend a lot of time doing, I know reference calls, everyone talks about reference calls. It's less so about like calling the companies you've been involved with and more so about the GP universe and what either your prior organization or people within your subsector think of you. Like reputation is important. And so it's not necessarily always an easy number that's on a page that you can look at. A lot of times just understanding, how are you different? What is it that you're bringing? What rooms are you getting into that others are not getting into? And who like, why would a company want to partner with you? We just did an emerging manager. She was a 20-year operator. And when I talked to one of the people in the industry who brought her into a deal, they were like, we could not bring her into the deal. She hadn't even raised the fund yet, but like we needed her. And when you hear that, it just gives you comfort around sort of. And so then you have to layer in like institutionalization. Who are you using on like the back office? And again, who's your team? So there's a lot of different layers to evaluating if there is a track record, but we're comfortable and that's where we spend a lot of time.
As a former placement agent, that is just great advice. Package it, spoon feed it, do the work. So I think we can leave it there. That's terrific advice.
I have nothing to add. I thought that was brilliant.
Good. Okay. So we'll turn in our last couple of minutes to some final reflections and wrap up from the group. I'd like to go back to you, Katie, and ask you if you would help clear up some myths or a myth around impact in investing, or in particularly DEI investing. There's so many, I think, misconceptions out there. What would you like to clear up, or could you clear up in the minds of investors in our audience?
Sure. I mean, I'd say if there's an LP in the group that hasn't yet been able to buy their board into the business case here, let me help you. Let our organization help you, because we have the data that, like when you're thinking about these funds, you're thinking about risk and return, just like you are with every other established manager. And we have the data that shows how these organizations can perform, both over vintage years compared to peers within sector spaces. And the data is really good. I mean, top quartile emerging and diverse funds have done exceptional, especially the top quartile. Now, what I will be honest about is the dispersion of return within those managers is very wide. And so you've got to pick well. And so not every organization is going to get a yes, right? There's a lot more no's than yeses. But for us, helping make the case that that these managers are absolutely validated and should be included as part of portfolio construction is something that folks sometimes need help with, and come to the ones that have done it, and we can help you to sort of think about how these fit better into your portfolios, because they should be. And I think that is a myth around this, is that emerging managers come with more risk, and I think we have the data to say otherwise.
That's great. Thank you, Katie. Roy, similar question for you, and that is what advice do you have for other LPs, for asset owners who might be saying, I'm not sure this is for me, sitting sitting on the sidelines, what's the case that you would make for them? You are mute, unmute.
Yes, I say some of my most brilliant remarks while on mute. I think Katie made the kind of the brilliant business case, which has been around for decades. The data has been there for decades. Professor Josh Lerner, for the past sort of 7 to 10 years, has highlighted it even more, and has some of his data shows that diverse fund managers actually outperform but part of that might be not due to some superiority in terms of their makeup, but more kind of the law of small numbers. Diverse fund managers tend to have significantly smaller fund sizes, and it's just easier to generate higher numbers with small firms. I do want to talk about the social. I'm going to not use the term social. I'm going to use the moral case. So there's a business case and a moral case, and we can get into some deep discussions about moral relativism, and is there really a single moral standard about looking at this, particularly a moral application of capitalism? I would like to believe that fairness still matters in America and in the world, but I'll focus on America. I would really like to believe that fairness still matters. And I also will point out that the reason we are at the statistical numbers we're at is because of unfairness. And I think we all know that. So hopefully the moral goodness that I would like to believe that we all embrace, hopefully that will win out. This time will be different because people will embrace fairness. And with that embrace, over time, I believe things will get better. So I'm glass half full. I'm optimist on this. So let me stop there.
Great, thank you. I'm glad we've got the fairness and the business cases made. Jen, I'm going to give you the last word on our panel. Again, kind of wearing my placement agent hat from the past. At the end of the day, GPs answer to LPs, and they change when LPs pressure them to. What is your outlook on change given that, and what should we be watching for in that regard?
I think we should absolutely anticipate something Katie alluded to earlier, which is the questions are going to come. If they're not coming today, they will be. And so we certainly hear from our 585 member institutions that are part of ILPA that they are rolling out the diversity metrics template now. They are asking harder questions during diligence now about DE&I. So the questions are coming if they haven't come already. And I don't see that slipping away whatsoever. I also believe that as we move away from just the diligence conversation, so spot in time, and I'll come back maybe and revisit on your next fund. No, I'm asking these questions annually. So increasingly, the LPs are asking their GPs, not just that one spot in time, what have you done with your numbers, but this is the beginning of a conversation that we are going to revisit over the life of this partnership. And it will continue. And I do expect as the LP to see progress from my GP. So I think the conversation is fundamentally evolved. And like Roy, I hold have a lot of hope, and I hold that with promise. And I do believe that we're going to see some real change in the near to medium term. Let's hope.
Great note to end on. Well, thank you to the audience who joined us, and thank you so much to the panelists for your time and insights today, and for the change you're leading in the market. Thank you.
Thank you.
Thank you.